All right, so part 3, we're going to really dive into the Schedule K-2 now. So we're going to revisit the fact pattern, look at Schedule K-2, the relevant sections and parts that we'll be completing based on our circumstances, and then we'll also flip back to the 1065 here and there just to make sure that we can see kind of how these numbers are flowing through the return in total. So if we look at the, let's look at the financial statements first again, just kind of recap here. So Schedule K-2 really is reporting the income items, right? There are going to be some sections where balance sheet items are relevant, but for the most part, it really is what we see on the profit and loss. So remember, all of the income and expense activity for this group is happening at the Cayman Islands entity level, and everything is just passing up through that Delaware LLC holding company. So we have the revenue, cost of goods sold, there's our net gross profit, various expenses, and we have some interest income that is earned on the Cayman Islands bank account. Okay, we don't have any interest income on our USD account here in the US. It's just a general checking account. So if we jump back and take a look at the return here, let's start to look at the K2. So K2, a good way to think about this conceptually is this is filed with the partnership return and it reports the totals. K3 is just like K1, is that it's the allocation of those totals across the partners based on either their ownership percentage or whatever kind of special allocations you have at the partnership level. So talk about a little bit about this top section here, and then we'll start to get into the relevant parts that are actually being completed. Remember, if we go back to our slides here, the parts that were being completed for this fact pattern are parts 1, 2, and 10. All these other parts are not relevant for the reasons that I outlaid in the very first video, but you might still get prompts for these if you're using a tax preparation software. They might still ask you, oh, you need to complete something here, or tell us why you're not completing it. But for purposes of this example, we're doing parts 1, 2, and 10. And the sections within, and so I'll go through each of those and show you why we're completing them, and again how we're arriving at those numbers. So parts 1 and the section above. So the section above here, pretty straightforward, right? It's name of the partnership, the EIN, and then in A and B, it's asking us very precise questions here about whether this is a withholding foreign partnership or a qualified derivatives dealer. You're going to know it when you see it. I mean, if you're withholding foreign partnership, it means first that you're a foreign entity, so you're not a U.S. domestic partnership. You're a foreign partnership, and you've entered into an agreement with the IRS to act as a withholding foreign partnership. This is not the case, right, for both reasons. One, we have a domestic LLC, and we haven't entered into any kind of agreement with the IRS to be withholding foreign partnership. And the same thing with the derivatives issue. I mean, this just doesn't apply to us. So A and B are both no. Now, question C here, it seems kind of bizarre that they would do it this way, but basically what they're asking us here is simply just yes or no. Are we attaching parts for reporting purposes? So if we are doing part 1, part 2, check yes, and then complete that part. If you're not doing the part, simply check no and then leave that whole part or section blank and don't bother including it with the return. I guess this is just to serve as a summary. That's really what it is. So figure out what parts you have to complete them, and then check yes or no depending on whether you've actually included with the return or not. Right, so again, remember, we're doing parts 1, 2, and we're doing part 10. So we've indicated yes for those 3 and then no for the remaining parts. Now, part 1 here, other current year information. This is completed if you have information that wouldn't fall within one of these parts up here, 1 through 12, and you need to attach additional schedules or supplementary information. In our case, we do, right? We have information on 8858, so the foreign disregarded entity, and then high tax income information. So this often applies. High tax income is a separate computation for U.S. persons that have passive income from foreign sources. So even in cases where your passive income might not be subject to foreign taxes, you still have to check box 5 and include the worksheets, even though, again, in our case, we don't have any taxes on that Cayman Islands passive income, but we still got to do it anyway. Now, the other pieces here, I'll just touch on these briefly. Gain on the sale of personal property. This would be like if you sold stocks or bonds, right? Those are treated as the sale of personal property. It's sourced to the residence of the seller. We don't have foreign oil and gas tax issues, no splitter arrangements. Box 4, foreign tax translation. This would be necessary if you paid foreign taxes, right? Because remember, foreign taxes have to be translated to U.S. dollars when reported on the return for foreign tax credit purposes. So if we paid foreign taxes, we would have to check box 4, show those translation adjustments. But in our case, we're in the Cayman, so we don't have any foreign taxes. 267 Cap A, this is doesn't apply to us. This is any kind of deduction taken for interest or royalty payments to foreign affiliates. It doesn't apply to us. We don't have any interest or royalty payments, nor do we have any foreign affiliated entities that we're doing business with, so not going to apply to us. The 5471 information could be relevant, but we made a check the box election to be a DRE. So 5471s are filed for controlled foreign corps. So could often be the case where you have to include some additional information for those U.S. owners. No partner loans, right? We just have capital contributions. We don't have DCL issues for losses, and then no other items. So again, in this example, I'm trying to keep it relatively straightforward here. We don't have a lot of unique items up here. We just have the high tax income issue, which I'll show you that worksheet, and then the 8858 disclosure for a foreign disregarded entity. What's unique about that is you don't actually have to attach the 8858 to each Schedule K-3. You just have to indicate that there is a disregarded entity, and so the owners know about that issue. Okay, so now if we really get into the meat of this, starting with Part 2, the FTC limitations and Section 1 on gross income. All right, so how does this work? So Section 1, gross income, is where we separately state by category the type of income, so top to down, and then across left to right based on its source and the type. So in our example here, we have income from the Cayman Islands, right? So each line item, so you see here A, Cayman Islands is the line item. In order to keep this as clean as possible, what you should do is use the Cayman Islands. If you have various types of income, keep it on line item A. So we have line item A, Cayman Islands, our gross income from the sale activities there. And then if we scroll down, I'll just touch on this so you can see what I mean. If we get down to interest income on line 6, you can see here we have Cayman Islands again, 32. If you have income from the Caymans, the U.S., and multiple other countries, keep them separately categorized in each line item, right? So in other words, if we had income from Germany, we have Cayman on line A, Germany on B, and everything attributed to Germany would be on line B, no matter where we went throughout this schedule. So if we go up to the top here, Part 2, Section 1, we can see here we've got U.S. source, column A, and then the foreign source items, and then source by partner. Source by partner are things that cannot be sourced by the partnership. It depends on who and where the partner is located. For example, sales of personal property, right? If we are selling stock or bonds, those are sourced by partner, so those net gains or losses would be entered in column F. If we had U.S. source effectively connected income, right? So if we had a U.S. trader business and it had ECI, that item would be reported in column A. Or if we have foreign source income, we report them somewhere columns B through E, depending on the category. And we are making this determination at the partner level, the partnership level. And the partnership has determined that the activities of this entity, given the branch, we have income from sales activity that's foreign branch category income. So the trader business activity that we would see on page 1, Let me jump up to page 1. So this is what we're talking about. This trade or business activity here, all of this is foreign branch category income or loss. And so that's why it's being reported in the foreign branch category column. So if I jump back down to Schedule K-2 here, the net sales income, right? So net gross income, or gross income rather, derived from a trade or business is your sales net of returns and allowances and minus your cost of goods sold. So I've got some notes on the financial statements here if you want to look these up just for your own reference. But what's kind of a bit of a oddity, I suppose, is that when we talk about gross income from a business, gross income is actually your sales net your cost of goods sold, because cost of goods sold isn't looked at as a deduction under Section 162. So if you go look at Treasury Reg Section 1.61-3A, you can see that definition. So that's why when we talk about gross income reported on Schedule K-2, we're actually looking at the gross profit here. So what are our net sales less the cost of goods sold? Gross profit 322,300. That's why that number is being reported on Schedule K-2 in Section 1 in column B for foreign branch category income. So there's our $322,300 number. Now, the gross income section includes all these different types of income, right? So we have interest, dividends, royalties, capital gains or losses if they are sourced to that country. But the only other item of gross income we have in this fact pattern is the interest, right? So if we look at the financial statements, we have gross interest income here from that Cayman Islands account totaling $32, right? That's after we did the exchange rate. So if we go back and look at Schedule K-2, Section 1 here, we can see that we have to report the interest income in section or line 6, right? So where on line 6 would we report it? Well, again, think about the sourcing. This is not U.S. source income. It came from Cayman Islands bank account. So it's not U.S. bank interest, so it's not in U.S. source. And we're not sourcing it by partner, right? So interest income is sourced to the location of the payor, right? So who is the payor of the interest income? In this case, it's a Cayman Islands bank. It's a Cayman Islands financial institution. And so we're reporting $32 of interest, and it's passive category income, okay? It's not included with the branch income. Okay, so that covers the gross income items. And if we scroll down to the bottom, they do summarize all the totals here. So we can see that our total gross income, all allocate to the Cayman Islands, includes the foreign branch category income, $322,300, and then the passive category income of interest for $32, and then there's the aggregate total. Okay, now if we go down to do the deduction section. So with the deductions, it's a similar issue, right? We're trying to allocate expenses to the appropriate type of income that we're earning and by source. So expenses allocated to the sales income, we have the foreign branch category income, 224,901. Where did this number come from? That's the total expenses that we see here on the P&L. Other operating expenses, 224,901. So that's why we're reporting those values here in this sales section. Obviously, if we had other types of income and we had expenses allocated to those, you might report them in different line items, right? So in this case, we've got expenses just allocated to sales. That's it. We don't have any other services income or capital gains or loss, and they have other sections here for royalty and licensing expenses. Again, we're trying to keep this example pretty straightforward so we don't have any of those income items, and then accordingly we don't have any of those expense items. So that's why we're leaving all those off. So we've got our foreign branch category expenses. There's the total. And at the very bottom here, it's the very bottom of section 2. We can see we've got total deductions, 224,901, and then net income or loss. Now, these should generally match with what we see on the 1065 itself, right? So we have the net income or loss from ordinary trade or business, $97,399, and then the interest income. and there's our net income or loss per books figure. So 97,431, that is our net income or loss per books here, right? And we can also see that on the 1065 and Schedule M1. But that's our net income or loss per books. That's the amount that's passive category income, and that's the amount that's ordinary trader business income. Okay? Okay, so now that we've done part one, we've done part two. So if we look at our slide deck again here, the sections that we are completing, part one, part two, and then part 10 for foreign partners, character of income and deductions. And this is probably the most important one for our non-resident partners. So if I jump down here to part 10, we have foreign partners, character and source of income and deductions. So this section works very similar to the part above where we talked about gross income, foreign versus U.S. source for foreign tax credit purposes, but it's very different in that what it highlights is not just the source of income, but based on its source, whether or not it's subject to taxes at the U.S. level when allocated to non-resident partners. Okay, so if we look at column A here to start, this is the totals of all the gross income and the gross expenses that are allocated to the partners. And then as we move from left to right, we recategorize or break out this section based on the source and whether or not it's going to be subject to tax. So part B, partner determination, very similar to the discussion about the foreign tax credit issues, right? This is where the partnership itself cannot source the income. It's sourced on a per partner basis based on the residency of the partner. In our case, we don't have anything like that, right? So that would be like net short-term capital gains or losses down here on line 10. You would generally see those reported here in column B. Again, not our case here. The partnership determination, this is what's really important for us. So we have two columns, ECI and non-ECI. So that's effectively connected income with a U.S. trader business, and then non-ECI. Now, if the partnership or that subsidiary entity was engaged in a U.S. trader business and had ECI, we would see some values here. Right, so we would report the ECI, and that allocation to the non-resident owners, so Jane in this case, would ultimately be subject to some withholding tax. So U.S. source ECI is U.S. source income that's effectively connected with a trader business in the U.S. It's also possible to have foreign source income effectively connected with a U.S. trader business. This generally happens when you have a U.S. office that is doing work on behalf of a foreign branch. And if that U.S. office has a permanent establishment or U.S. trader business, you can kind of impute this ECI issue to that foreign source income. Where we're working with is this non-ECI bucket here. Okay, so non-ECI is income that's not effectively connected with not effectively connected with a trader business, and it's separated into U.S. source income or foreign source. U.S. source FDAP or U.S. source other are types of income that are interest, dividends, rents, royalties. These are the types of income that are U.S. source, but they're subject to withholding tax at source and on a gross basis. The foreign source column here is the position we're in, right? We don't have any effectively connected income with a U.S. trader business, and it's all foreign source, right? All of the sales activity occurs outside the U.S. All of our customers are outside the U.S. The interest income earned on the bank accounts is non-U.S. interest income. So that's why we're reporting the net ordinary business income here, the gross income, right? Remember that 322,300, that is the gross profit from the company, right? 322,300. And then we have our interest income here, $32, again, foreign source, non-ECI. If we scroll down here to the deductions, similar discussion, right? So we've got expenses related to ordinary business income, the gross income. There's our expense number, 224,901. And then the appropriate column is all the way at the end here, foreign source income. okay? And then if we continue to scroll on down here towards the bottom, we can see the totals and the net amount. So the net income or loss in the total column, 97,431, that is our book income or loss, right? We can see that reconciles with, oops, sorry, let me jump back up here. 97,431, just so we can get familiar with these numbers again. So that's our net income or loss per books, as shown in M1 and M2. So if we go back down, there it is, 97,431, right? So that is the net income or loss in total on this foreign partner character and source of income worksheet. And so that's why we are, making sure to really pin down the sourcing of these based on whether it's U.S. or foreign. Now, the last little bit of Part 10 here summarizes the source of income and deductions if we have any ECI. And so this is really important if you had a foreign corporate partner, right? It's kind of a mood issue for Jane because she's a non-resident. She's not filing a 1040NR. She just doesn't care, right? All she cares about is, am I subject to tax in the U.S. or not? I'm not. Who cares? But when you have foreign corporations that are filing 1120Fs, it's very important for them to know their allocation of ECI versus worldwide earnings, average assets, liabilities, personnel, because those go into a lot of schedules that get included with that 1120F filing. So we've included it here just for completeness, although it's largely a mood issue for Jane. But in Section 3, we have to report the gross amount of ECI. Remember, in this case, we have none. There's no effectively connected income with a U.S. trade or business. The worldwide gross income is that same number, right? 322, 300. And then the assets and liabilities section here, the average U.S. assets and worldwide assets. So we take averages, right? So the average is, if you're not a bank, there's basically 3 break periods, right? So you take the assets, you look at the financial statements, and you take averages at the start of the year, the middle of the year, and then the end of the year. Average those 3 together, and then you're done. And so that's what's happened here on the asset side. We don't have any U.S. assets that are generating ECI because, again, we don't have any ECI. But we do have average worldwide assets, so we've added that. And then U.S. liabilities, same issue, right? So we're trying to find out U.S. book liabilities are those liabilities on the books that are directly related to the effectively connected income earned by the company. In this case, we certainly have liabilities, but they are not U.S. They're not liabilities connected with this U.S. trade or business or U.S. ECI because we don't have any. And then directly allocated partnership indebtedness is a reference to certain qualifying non-recourse indebtedness, which we don't have any of that either. Question 4 is a simple kind of numerical number just about total personnel, right? So what they're asking here is, when we look at our payroll, right, what were the number of personnel we had working for the company worldwide, and then what are the number of personnel we have that are working on that U.S. trade or business element. So in this case, we had 3 employees based full-time in the Cayman Islands. That's it. And then the number of personnel connected with a U.S. trade or business is 0 because we don't have a U.S. trade or business, right? So this is pretty straightforward, given this fact pattern. But you can imagine how this might get a little more complicated, right? If you have personnel that are working for a number of different entities in a consolidated group, maybe it gets a little more tricky. But in our case, pretty straightforward, right? Remember, when we look at our structure chart here, this entity up here, this holdco in Delaware, is doing absolutely nothing, right? It really is just the equity owner of this Cayman Islands entity. And so when we complete schedules such as this, we can very confidently say that, okay, our worldwide personnel figure is 3. That's the number of employees we have in Cayman. We really don't have anybody in the U.S., so that's why we've left that section blank, okay? The last part here is this worksheet. Let me jump back up to the top there just to revisit this. So remember, in part 1, we had this high tax income checkbox here on line 5. And the high tax income worksheet has to be completed when you have passive income, whether it's subject to tax or not. But you have to separately state the amount of passive income and the allocation of taxes to it, and then where it falls within this category. So in our case, the income we have is attributed to this fake store limited. So this is our QBU, or qualified business unit. And then the passive income, that interest, that $32 in interest, falls within line D for this worksheet, right? So we have passive income that's not subject to any foreign tax, and that's because we're in the Cayman Islands, right? We have no taxes in the Cayman Islands directly. Certainly, you could find yourself in a position where you might be in one of these other line items, right? So you could have interest income earned from, let's say, the UK. If your UK company had passive income subject to withholding tax of 15%, you would have reported that here in this column, and then the amount of taxes withheld in column 2 here. But again, in our case, we're trying to keep it really, really simple here. So we have a Cayman Islands entity, no withholding taxes, no taxes, period. So we've just separately stated the passive income not subject to any tax, and then $0 in taxes, right? So pretty straightforward, right? Trying not to create any more headaches with this example than we need to. Okay, so let me jump back to the slides just to make sure that I've covered all those pieces. So so this is part 3. We have done the fact pattern in Schedule K-2. Now for part 4, we're going to go into more detail on the K-3s that are being allocated to each partner, show you how some of those numbers work, and where those values are also reported on Schedule K-1.